Hello everyone, welcome to this audio PowerPoint presentation entitled Best Buy, Maintaining Brick and Mortar Relevance in an Online World. We're going to be talking about Best Buy and how they're faring now and what their strategic problems are heading into the future, faced with such competition as Amazon.com. We're going to talk a little bit about what the company is doing now, a little bit about the history of the company, and how big brick and mortar stores like Best Buy are struggling with actually keeping up with online retailers. The main problems being just having the overhead of actual brick and mortar stores. That's going to actually cause a lot more cost than something like Amazon would have with just a few warehouses scattered throughout the country. In this presentation will be me, Eric Fortenberry, Mei Liao, Michael Hazelhurst, Chris Neely, and Scott Evans. Stick around, we're getting started. Let's first talk a little bit about the history of the company. Everyone knows Best Buy now is the largest electronics retailer in the world, but their first store opened in 1983. This year marks the opening of the first Best Buy Superstore. Prior to that, the owner and founder Richard Schultz had operated several stores under the name Sound of Music. These are what he initially had. They were consumer electronics, mainly high-fidelity stereo stores throughout the Minnesota area that he had been running. Those are what eventually turned into the Best Buy company. But the store that opened in 1983 was the first one to feature a high-volume, low-price model that all the future stores actually started to maintain. It became incredibly profitable, debuted on the stock exchange in 1987. Best Buy gradually built itself into the behemoth that we know it is now, becoming the largest electronics retailer in the world, but based on a pretty old business model that was basically standard retail, high volume, low price. They did implement a strategy of sort of hands-off salesmanship. There was no commission-based sales, so the customer was able to feel relaxed in the store. But when the internet retailers such as Amazon started getting into the consumer electronics game, it took a big hit of the market share. I mean, Best Buy, Circuit City, a couple of other companies were actually doing well on the retail side of that. Circuit City actually closed down, mainly due to Amazon's influence. Once they got into the consumer electronics game, it became very difficult for these other brick and mortar stores to keep up. A number of factors contributed, just ease with which customers could order online, and just the amount of overhead that the brick and mortar stores had, employees to work in the store, obviously just rent itself. All of these contributed to higher costs on the back end for Best Buy that made it a little bit difficult for them to keep up with companies like Amazon. Currently, despite Amazon's growing influence, Best Buy is still in all right financial shape. They're still the largest electronics retailer in the world, but the challenges just keep mounting. Initially, in the late 2000s, the stock price was just dropping rapidly. The company had failed to change their current business model to keep up with the challenges of the competitors with which they were faced. They were still running it like they were only competing with other brick and mortar retail stores. Didn't really do too much to focus on competing with the online retailers, which were becoming actually their greatest threat. There was a big drop in stock price in 2012, and that prompted the board to elect a new CEO, Hubert Joly. He actually had some pretty good ideas for where to take the company. I'm going to get into those in the next slide, but due to his influence, the stock actually tripled in 2013. The company was doing well. They had implemented some new ideas that were making them competitive with the online retailers. Unfortunately, that was basically a short-lived trend. The stock's currently declining again. The recent turnaround engendered hope, but it's still going to be difficult for them to keep up. I mean, Amazon's established such a large presence, and Best Buy, along with all brick and mortar retailers, are really having to fight an uphill battle. Before Amazon started selling consumer electronics, Best Buy was basically on top of the world. They were expanding, rapidly opening stores all over the world. They opened in China and Puerto Rico, and basically were just buying new stores based on the assumption that they would still be viable in the near future. Unfortunately, Amazon decided to get into the consumer electronics game and really took a bite out of the potential customer base. Best Buy found itself with a lot of new stores opening that weren't doing as well as they had envisioned. They found themselves in the unenviable position of having invested billions of dollars into a business model that was no longer able of competing properly with what their current competition was. The prevalence of online retail necessitated change. Best Buy was fairly quick to respond, but until the new CEO, Hubert Joly, was hired, they were still floundering. But Joly brought with him a fairly revolutionary idea. It actually turned around Best Buy's stock prices for a significant period of time. He entitled this the Renew Blue Initiative, and that's what we'll be discussing in the next slide. This initiative was designed to go after the online retailers. The problem of showrooming was big. That'll be discussed later in the presentation, but basically Joly had to come up with a way to compete with the online stores. One of the main ways to do this was to accelerate online growth. Best Buy's website was introduced. They spent a lot of time focusing on that, the user interface and the actual pricing. Escalating the multi-channel customer service. Services like the Geek Squad, which was a troubleshooting / mobile help desk for Best Buy customers, actually made customer service easier for people who had purchased from the store. Customer service in-store was stressed. Joly also wanted to increase the revenue per square foot of the store. These were rent costs that were fixed costs, already had to be paid, so there was no point in wasting any space that they were already sinking money into. More products on the floor, specific deals, exclusive deals with other companies to showcase their wares in Best Buy stores. Plan also was focused on cost cutting in the cost of goods sold area, reducing SG&A costs, which is the selling, general, and administrative expense. Keeping that down is just basic cost cutting. Trying to keep the overhead low. Best Buy actually did a pretty good job of implementing all of these plans for at least a while. They also initiated a price matching plan, whereby if someone saw a price on an online retailer, mainly Amazon, Best Buy would match it in store, and they actually did drive their stock prices up for a brief period of time. Again, currently the stock is falling again, but Joly's ideas were viable for at least a couple years. I actually got the stock prices rising pretty high. Unfortunately, all that matters for the health of a company is the present and the future, more so profitability in the future, and that's where Best Buy is going to have to probably rethink a few strategies. The price matching, all of Joly's ideas worked pretty well, but they're already starting to show signs of weakness. Best Buy's stock prices are falling once again. It's going to be quite difficult for them to actually come up with something to compete with these online retailers long term. The question we'd like to ask is, can this company remain profitable? Is there something that Best Buy can do to remain viable in a world that's increasingly driven by online sales?
Hey guys, my name is Michael Hazelhurst. I'm going to go over the financials with you for Best Buy. Best Buy is actually listed on the New York Stock Exchange. This chart here shows you 5-year historical prices. Looking at the chart, we have the volumes over on the left. On the bottom, we have the years from 2011 to 2015. And on the right, we have the price of the stock. As you can see, between 2014 and currently, the stock has gone up quite a bit, and that's over 50% in the past year. Looking at our financial summary, we have the key indicators here of revenue, gross income, EBITDA, that's earnings before interest, taxes, depreciation, and amortization. We have EBIT, and we have net income. And below each of these is the growth in percentage, and then we have the margin growth in percentage. At the top, we have the years from January 2015, Q means quarterly, and then we have April 2015, which would be the next quarter. That's an estimate, E for estimate. We then have January 2014 annual number of $42.41 billion for revenue, and then January 2015 annual number of $40.339 billion. As you can see, that's roughly 5% or 4.9% negative growth. The next items are January 2016 E-year estimate and then January 2017 E-year estimate. Those are the forecasted numbers for revenue, and they're forecasted to be negative 1.1% for the next fiscal year, and then in 2017 a slight uptick to 0.5%. So revenues for the next 2 years appear to be relatively flat. Our next numbers are gross income, and that reflects the margin of income to revenue. You can see for 2014 annual it's 22.2% margin. For 2015 it grew about 20 basis points to 22.4, and then for 2016 and 2017 there's just a very slight uptick of 10 basis points and then 20 basis points for the 2017 number. Going on now to EBITDA and EBITDA margins, we see a little bit of improvement from 2014 to 2015 annual year data, 4.2% margin to 5.2%, which is pretty decent. And then our forecasted numbers are fairly in line with what they're forecasted for gross income margin at 5.4 and 5.7% margins. Our EBIT numbers, which do not add back depreciation and amortization, are 2.5% margins for 2014, 3.6% margins for 2015, with slight improvements over the next 2 years. If you look at the net income, the last item that we have here, you see the 2014 annual margin percentage was 1.6, and then they almost doubled that into 2015 to 3.1, but it's forecasted to come back down closer to that 2014 number for 2016 and 2017 at 2.3%, 2.5% respectively. Next, we're going to move on to the income statement. And with the income statement, these numbers are in millions of US dollars except for the per share data. Our top line here is sales, and you can see over the past 5 years from February 2011 to the current fiscal year, our sales have decreased about $10 billion from $50 billion in February 2011 to $40 billion currently. Our cost of goods sold has decreased, but not as much proportionately as it should have. Our gross income numbers have come down from $12 billion to $9 billion in the most recent fiscal year. And while our operating income, or EBIT, is not what it was in 2011 at $2.3 billion, it has been an improvement over the past 2 years from 2013 and 2014. One interesting item I'd like to note is that our net income is $1.246 billion, which is really close to that 2011 number. And that's interesting to note because the sales, even though they've gone down by roughly $10 billion, the net income has remained fairly close to what it was in 2011. So that indicates that there are some more operational efficiencies that have undergone. That's then reflected down at the EPS for recurring and diluted. Our diluted EPS has really increased over the past 4 years from negative 3.36 in 2012 to 3.48 currently. And our EBITDA has also increased over the past 2 years to $2.099 billion. Now going on to the balance sheet. Again, these numbers in millions of US dollars except for the per share data. There isn't a whole lot to note here. There is some slight volatility with cash and short-term investments, and a bright spot on this balance sheet is that the cash and short-term investments for this most recent year is the highest on record that we have here in front of us. And our total current assets are $11.729 billion. Another note that I'd like to point out is that our total current liabilities are $7.777 billion, which have come down relatively over the past 8 or so years. If you look at 2009, you've got $8.4 billion, and then that's increased or stayed flat all the way up until 2013, and then they were able to bring that down roughly $3 billion over the subsequent 2 years. We have the cash flow statement next. One quick and dirty way to calculate free cash flow, which is a really important metric in the world of financial analysis, especially when you're talking about equity research. We take the net operating cash flow item that you see there in bold, you subtract it from the CapEx or capital expenditures, and if you take those two numbers, we got $1.935 billion net operating cash flow, and we subtract that from $561 million of CapEx. We get our number down here at the bottom, our free cash flow of $1.374 billion. For various reasons, you can see over the past 10 years or so, that number has been all over the place, from a low of roughly $446 million to a high in 2012 of $2.527 billion. But we feel pretty healthy about our free cash flow situation, and it's one of the higher on record over the past 10 years. Investors like to see this number because it indicates the health of the company and its ability to meet its current obligations and fund acquisitions that will make it more competitive. Now we're going to take a look at the comps chart, and this is basically, if you remember from some of your finance classes, a comparison of other companies that are operating in the same space. And here we have Best Buy at the top, as you can see with that little gold arrow. We then have Amazon.com, Apple, Walmart, Sears, and Staples. And then we've got their fiscal period, so when they end each year and come out with their 10K. We have the price, and Best Buy's price right now around $37.80 as we last checked is relatively cheap. As you can see, the average is $130, the median's $80. Amazon's really high at $385. Staples is about half of ours, and Sears is a little bit more. Shares outstanding were relatively low. Below the median of 640 at 352. Our market value is very much lower than the median or average. Sears and Staples are the only ones that are sort of near us there. Sears is the lowest. Shares outstanding, again, we're about half the median. Our enterprise value at roughly $10 billion is well below the median and is the second lowest in our comps chart. Our sales at $40 billion is the third lowest, and our EBIT is slightly above the median, which is good, but nowhere near Apple or Walmart. And then EBITDA at $2 billion is slightly lower than the median, but it is better than Sears and Staples. And then here, something that concerns me is the enterprise value with respect to EBIT and EBITDA at 7.53 and 5.18. That's, well below the median for both items. Finally, we're going to take a look at our current capitalization here. you have on top the price and multiply that by the shares outstanding, gives you market cap or equity value of $13.252 billion. If we want to get down to our total enterprise value, the last line item that we have here, we have to subtract out cash and short-term investments of $4.072 billion, add back total debt $1.621 billion plus preferred equity, which is zero, and minority interest, which is roughly $5 million, to get our total enterprise value at $10.806 billion. This is actually a bad sign. It means that, as I said earlier, the equity value is trading at a premium to the enterprise value. So in that case, sadly, we're going to want to recommend that you sell or short the stock if you're looking at it from a technical standpoint. I'd like to thank you guys for taking the time to listen to me, and I hope this was helpful, and I'll look forward to passing it on to my next teammate. Thanks and have a good day.
In 2012, Best Buy announced that it had more than $1 billion loss in previous year. I believe that it was disaster news for Best Buy. So why this happened? The quick answer is because of internet, especially the development in e-commerce. At that time, online retailers such as Amazon also started to sell electronics. That means Best Buy not only competes with traditional retailers, but also online retailers. Let's see what was happening a few years ago. You, as a customer, walked in a brick-and-mortar retail store, look around, check out a product, and finally make up your mind to buy the one you want. But you were not buying it from Best Buy, but from other online retailers, such as Amazon. What you did was comparing Best Buy price with online price, which was normally lower than in-store price. And of course, as a rational consumer, you choose to buy it from the online retailer, which is normally cheaper, and you had already seen the product in reality from brick-and-mortar retailer, such as Best Buy. This is called showrooming, which is exactly the primary reason that drove Best Buy in bad situation. Consumers always look for a lower price, especially when the product is identical. We cannot blame on consumers for treating Best Buy as big showrooms. What Best Buy should do is to anti-showrooming, and Best Buy actually does take some actions to fight back. Price matching strategy is one of them. Best Buy promised to match its price to other local retailers' price, as well as online retailers for its customers. The outcome of this price matching strategy is distinct. As Michael has mentioned earlier, the net income of Best Buy in 2011 was negative $1.06 billion and negative $483 million in 2012. Since Best Buy implemented price matching strategy in 2013, the net income started to increase. In 2013, Best Buy had a positive net income of $687 million. In 2014, it reached to $1.2 billion, which brings it back to the same level as 2010, which is $1.27 billion. It looks like the price matching strategy has saved Best Buy so far. However, the question is whether this low price strategy is sustainable and keeps Best Buy in business in long term or not. The profit margin in consumer electronics industry is already very thin. Once implementing price matching strategy, the profit margin becomes even more narrow. Implementing this strategy, Best Buy also makes some investment. One of them is training its employees in order to compete with its competitors, such as Amazon and Walmart. Best Buy invests lots of money on training its in-store employees to become more knowledgeable about their products. Educating employees also requires plenty of time. However, once employees become experts on products, they will ask for more than minimum wage. So this increases the cost, which means it decreasing profit margin at the same time. However, comparing to online retailers, the reason that online retailers are able to offer low price is that the salary and overhead costs are much lower than the traditional retailers. Instead of having tons of physical stores, online retailers only need some warehouses or distribution centers. Also, online retailers require much less staff. Salary normally is a big portion of potential operation expense. So the total operation expense is significantly lower than the traditional retailers. If Best Buy is able to offer lower price, why online retailers cannot? Yes, of course they can. However, we all know that once price war starts, it's a dead cycle. Online retailers probably have big enough room to drop their price to survive or even still be profitable. But how about Best Buy? We can anticipate now that once this war begins, Best Buy will probably be another Circuit City, which unfortunately went out of business in 2009. I know it sounds sad, so Best Buy's price matching strategy is not a sustainable solution when competing with online retailers. To fight back online retailers, Best Buy also launched its online segment. Accelerating growth in its online segment remains one of the main focus for Best Buy so far, as it aims to update its website to get on par with Amazon and other competitors. Best Buy's online sales, which currently account for approximately 13% of its total sales, grew 12%, 25%, and 20% in fiscal year of 2012, 2013, and 2014 respectively. Among bricks and mortar competitors, Best Buy has 18% market share in its categories, but among online retailers, its share is only 7%. The company aims to get its market share among online retailers at least at par with its share among bricks and mortar stores in the next few years. From the above discussion, we can conclude that price matching strategy is not a sustainable strategy for Best Buy. It keeps Best Buy alive for now, but I truly doubt that it won't last forever. On the other hand, Best Buy's current low market share among online retailers illustrates that there is still a lot of room for Best Buy to grow. But how Best Buy is going to win this battle? In the following presentation, my teammate will have further discussion on the solution.
In an effort to determine how Best Buy arrived at its dilemma, I believe it's important to understand the contributing factors which affected the retail sales industry in the most recent past. To analyze the challenges faced by Best Buy and other brick-and-mortar retailers related to their online retail competition, we have to review the origin of online shopping and how consumer sentiment shifted from brick-and-mortar retailers to online shopping. We can begin by reviewing the history of the internet and how it became the catalyst for e-commerce. We will look at a few of the recent events such as the recession, the overnight delivery industry, fuel cost, and tax considerations, all of which have impacted consumers' buying decisions in the most recent past. First, let's review the history of online shopping. After the advent of the internet, online shopping was invented by English entrepreneur Michael Aldrich in 1979. In 1980, Aldrich launched ReadyPhone Office Revolution, which allowed customers, agents, distributors, suppliers, and service companies to connect to corporate systems online and allowed business transactions to be completed in real time electronically. The first web server and browser were created by Tim Berners-Lee in 1990. Some of the early online applications were used in banking and other services such as Pizza Hut. The first retail transaction over the web was completed by NetMarketer or Internet Shopping Network in 1994. The following year, 1995, Amazon.com and eBay launched its online shopping site, followed by an even larger Alibaba sites of Taobao and Tmall in 2003 and 2008, respectively. Because the barrier to entry into online e-commerce business is low, most new businesses prefer this entry point and thus the expanse of the e-commerce community. With advances in technology and the invention of electronic devices that connect consumers to the internet, such as cell phones and iPads, all these devices assist in the growth of the online retail market. Related technologies such as Facebook, email, Google, and other online resources have established online places for consumers to hang out and for business to advertise to customers. As such, online markets have expanded with more selections and offerings than its brick-and-mortar competitors. The recession and economic downturn kept many consumers away from stores during the mid to late 2000s, but online shopping stayed resilient through the recession as people spent more time at home and sought to find the best value for their money through the internet research. According to Forrester, the internet kept its popularity even during the economic recession, possibly because more than a third of European consumers shopped online because they couldn't find the products they wanted in stores. Online retailers were the benefactors because they were better equipped to adjust to meet conservatism during the recession due to the fact that they have a lower cost structure versus brick and mortar retailers. Other contributing factors are fuel costs and tax considerations. Fuel cost increases starting in the early 2000s leading up to the most recent past impacted consumer decisions to shop online versus expending valuable resources to commute to brick-and-mortar retail stores. Sales tax considerations also impacted a shift from brick-and-mortar retailers to online shopping. If a business doesn't have a physical presence in a state, it is not required to collect sales tax for sales in that state. This rule is derived from the 1992 Supreme Court decision, which held that mail-order merchants did not need to collect sales tax for sales in states where they did not have a physical presence. This law provides a significant advantage to online retailers, not to mention the cost savings associated with administering tax collection. Given Best Buy's footprint, one would assume its online sales must charge taxes. Therefore, it can realize an advantage that other online retailers may have. The sales tax alone could sway a customer's buying decision on a more costly item. Another contributor that has fueled e-commerce growth is advances in the transportation industry. The transportation industry supporting online retailers has changed dramatically over the years. The industry has a 99% on-time delivery history and has successfully met the growing demand of its e-commerce customers. Online retailers can expand its businesses alongside transportation company expansions into new markets without having a physical presence, such as a brick and mortar retailer such as Best Buy. UPS and Federal Express dominate the transportation industry domestically, and each continue to expand its global operations into new markets which benefit online retailers. All of the mentioned events and contributing factors have caused online retailers to flourish as customers seek the low-cost provider of goods and services.
Best Buy will now have to consider ways to change its business structure in order to compete in this changing market. They have two possible solutions available to them. One, they can cut costs through laying off employees, tightening up inventory control, and keep the price matching guarantee in place. Or they can completely change paths and try to explore new competencies and add value to the customer in other ways. And this would allow them to eliminate their price matching, and their best way to go about this is to leverage their superior employee knowledge and training and use that to add value to the customer and produce a product that people would be willing to pay more for. If Best Buy chooses to go the cost-cutting solution route, that means they get to continue price matching, and they're just going to be competing with their online competitors based on price. To successfully do that, they're going to have to cut costs, because otherwise they're not going to see any bump in their profit margins, and they're going to continue to lose money, and they won't be able to sustain the strategy. In order to cut costs, they're going to have to lay off employees, either through having less employees at physical locations and having less employees in general, or through closing some of their retail stores that are not making enough money and are not performing well. They're also going to want to improve their inventory management and take a page out of Walmart's book, who have some of the best inventory management in the market, and they'll want to cut costs that way, and that way they're not, the inventory they carry will not be as costly to them. And they're also going to want to limit their training costs, because currently they spend a lot of money on training their employees, and which gives them a lot of knowledge, but if they're just going to be competing on price, their employees don't have to be that knowledgeable. The downside to cost cutting is it's very difficult for brick and mortar retailers to compete based on price with online retailers, because online retailers don't have the employee costs and the rent and the cost it takes to maintain brick and mortar physical locations. And layoffs and closures of businesses don't send a strong message to their investors. It's going to cause a problem with their stock price. And also it makes it very difficult to attract and retain those employees that you want to have working for you. When employees see that you're laying off all these people and closing down stores, your current employees are going to leave, and nobody new is going to want to come because they don't think that their job's that safe. And investors are certainly going to stay away from companies that are laying off employees and trimming locations. The second option here is to change the product value. Go about it a new way and generate value to the customer in a different way. That way they'd be willing to pay more than what the online retailer is asking them to pay. This allows them to eliminate price matching, and they won't just be competing based on price. And they actually already have the structure in place to do this, because their employees have superior knowledge and training to their competitors. And they just need to use this competitive advantage more and in better ways. Currently, a lot of customers come to Best Buy's take advantage of the knowledge, leave, go home, and order the product online that the Best Buy employees told them was the best product for them. So there's two ways that they can think about trying to get customers to buy from Best Buy while they're there. One, they could theoretically think about using negotiable prices, allowing their salespeople to lower the price if they think somebody's going to leave. They would have to work that out in contracts with the product manufacturers, because not all manufacturers are going to be comfortable with having negotiable prices, but some of them will be. And if Best Buy attacks it from that way, it'll allow their salespeople to play on the psychological side of customers thinking they're getting a really good deal along with the information they're getting. And the other way to add value to the customer is offer post-purchase support, offer free installation for some of the bigger goods, do customer consultations, have regular checkups with customers to make sure that their products are working well, and if there's new ways that if the employee thinks there's different ways and better ways for the customer to use those products, have them available and have them call them. And adding that sort of value and leveraging the employee knowledge that Best Buy employees have will make it worth the customer's while to pay the extra money up front if they're getting that post-purchase support from the employees. And the reasoning behind pursuing this strategy is that online-only retailers can't match this competency. They cannot. This is a competitive advantage that Best Buy has over online retailers because Best Buy has physical store locations. Online retailers can't give knowledge in an effective way while the customer is considering the purchase. And post-purchase support is difficult for online retailers to match as well. They can do installation, but that increases their cost, and most online retailers just want to compete based on cost and price. And so they're not likely to offer that kind of post-purchase support that Best Buy can offer. And the other thing is that the knowledge advantage is already in place for Best Buy. They're not adding any more cost to themselves by doing this. Some of the post-purchase support stuff would come with its own cost, but they don't have to do any additional training for their employees. They may have to train them in some extra sales techniques to work on the negotiable pricing issues, but that cost would be worth it in the long run because of seeing more sales. There are some risks associated with this strategy. It's still likely that they're going to lose some customers to online retailers that are just going to go with the cheapest they can find it. There are some extra costs that if this strategy weren't to work, that Best Buy would lose some more profit. We discussed the additional training for sales techniques, which would be a little more expensive. Going out and doing installations would cost a little bit more. Offering free customer consultations also would cost a little bit because they have to pay their employees to do that sort of stuff. But we think that in the long run, it's worth it for Best Buy to do this because they need to compete on their competitive advantages. They can't compete based on price. They're not set up to do it, and it's very difficult to compete as a physical retailer with having to pay the cost of physical locations. It's very difficult to compete based on price against somebody like Amazon or one of the other online retailers. And they have this knowledge and training already set up for their employees, and it's very difficult for somebody that is an online-only store to compete with that. And so we think that Best Buy should use its current competencies and its competitive advantage in the knowledge and training area and leverage that into more profits by adding more value to their products and getting consumers to buy from them by offering this post-purchase support and allowing for negotiable prices. We think that would be the most effective way for Best Buy to turn its business around. And thank you.